Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
Mr. Sandman,
You get the idea?
bring me a dream.
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever
and
tasted.
tell him that his lonesome
Here's the
nights
Sandman.
are over, Sandman.
I want to ask you a question. Are you smarter than an 8th grader? Reason being is this past week, my client Jim told me a story about how the other day he and his daughter Jessica were making lunch in the kitchen when out of nowhere Jessica asks him if this bear market is going to ruin Jim's retirement. You see, Jim did well and he sold his company about a year ago. And since then, he and his wife Linda have been retired. But now that a bear market is on us, Jessica wanted to know if they were going to have to sell their house and move. Jim started rattling off to me facts about a bear market that he really didn't know, like we're officially in a bear market when the market falls 20%. And last week, well, it was off over 20% from the high. Long story short, my friend nearly fell over, not because he thought she was wrong, but because one minute they're talking about what kind of cheese they should put on their turkey sandwiches, and the next minute Jessica's talking about bear markets and how they can ruin the family's otherwise peaceful existence. So that got me thinking, this is exactly what's on your mind today, isn't it? What's a bear market? And what do you need to know about them? Even an 8th grader knows it. So today, I thought I'd give you the bear market quiz and see if you know more than an 8th grader. Good morning. How are you holding up? This is Protect Your Assets, and I am David Hollander. We got so much to talk about today. I'm so glad you're here. If you're feeling a bit nervous, unsettled, well, that's good. You should. This is about as crazy as things can get. I mean, it certainly can go down more, but that shouldn't matter to you if you're protected. You see, it's not about return. It's about income in retirement. If you've built yourself a Sherman tank when it comes to income, this kind of volatility, well, it's just noise that you have to deal with as sure as the sun is rising right now. So what can you do today to protect yourself? Are you able to recover this late in the game? Or will this new normal rob you of years of your retirement? Well, if this has you rattled, then you are at the right place today. Don't miss one episode of our sections today, because we're going to cover what's going on right now. So let's get started. Yes, the bear is back. Stinky bear. What do you need to know about a bear market? Well, we're going to get in today. The Dow was off this week, 7.9%. S&P off for the week, 9.1%. Now, year to date, it's almost off 14%. But what calls a bear market is from the top to the bottom within a certain period of time. So from the high this year to where we are now, 20%. That's a bear market. NASDAQ off 10% year to date. Again, from the high to the low, over 20%. MSCI still positive on the year, up 6.6%. So that's diversification. That's why you have international in your portfolio. 10-year bonds, quality bonds, year to date, still up a little bit. Good. Oil, well, down $62.63, off almost 10% for the week, and bonds, again, holding up pretty nicely. So, yes, tariffs were announced on April 2nd, and they were worse than feared. But at this point, I don't believe they're a bearish game changer for the year, and here's why I say that. Two reasons you need to think about. First, the administration implied that these tariffs are a ceiling and they're open in negotiations for global tariff reduction. So it remains a possibility in the coming months global tariffs could be reduced. Second, there were important exemptions, including all USMCA compliant goods like chips from Taiwan and drugs, pharmaceuticals from Europe. Those are major import categories and will help to soften the blow from tariffs. That said, I thought today, because so many of you are asking, I want to step back and I want to lay out for you the bullish case for stocks. Yes, one still exists. And the bearish argument that you're probably hearing about all over town. And then also, and also the worst case scenario, which is double bear. All right, let's talk about the bullish case for stocks. It's not a total washout, like I was saying. For much of the defensive sectors, even though this week has gone by, if you look at things like financials, healthcare, value, we're not that bad. Tech and consumer stocks are getting crushed, yes, but this market remains far from a total wipeout. And we typically will see that in a bear market. When you look at those indexes, I know they're not pretty to look at, and that's what they're showing you on TV. This is still a market that's rotating from tech and consumer, high expensive consumer stuff, to the rest of the market. That's encouraging. And I also think the Trump put still exists. What do I mean by that? Well, this current market calamity is very different from the two most recent ones, the pandemic and 2008 financial crisis. How? Well, it's manufactured by the government. President Trump initiated these tariffs with the stroke of a pen, and he could easily reverse them with the same pen. To that point, the Trump put still exists, although it may be lurking with this S&P down over 20% from the high. You got two senators, a Republican and a Democrat, introducing legislation this past week for new tariffs to require congressional approval. And while that bill probably won't pass, clearly Congress has taken notice of what's going on. And so while Trump may not be up for re-election, virtually everyone in Congress is.
Danger's my middle name.
And even Republicans will only tolerate this policy for so long if it fulfills fears and causes, you bet, the recession. So at least now we know the unknown tariffs are behind us, and the overhang has been removed, and the incremental direction for tariffs is now lower, not higher. So to that point, as long as it's reasonable to assume these tariffs will be reduced or eliminated again in 3 to 6 months, then it isn't a bearish game changer to my overall view for the year. Obviously, tariffs are not good for stocks, as you're seeing right now. Fear is surging. Markets will continue to be under pressure for the near term. But at the same time, the tariff policy is now known, and this removes a major unknown in the market we've been thinking about or trying to figure out. And so I think the direction will be towards less tariffs. Again, markets will stay volatile, but remember, if you miss the 25 best days since 1990, well, your average annualized compounded return on the S&P went from 10.6% to 5.8%. It's not very good. So don't try and time the market. This market is still overvalued. Let's talk about the bearish case. Welcome to the 1970s. Trump's tariffs declaration brings back memories of President Nixon and go down in history as a colossal mistake. But not before it revives stagflation. This is the bearish case, by the way. As prices surge, growth slows, putting the nation in an economic vice. Here's the arguments. First, inflation will go up. Why? Well, there's a combination of consumers front-running tariffs by buying things now and actual prices going up. And even if those are one-time disruptors, the jump in prices will keep the Fed from cutting rates, leaving the economy on its own. To total that up, it's a repeat of the 1970s where the Fed couldn't help support growth and self-inflicted a policy mistake. So, yes, the market's still overvalued, even if the administration's goals of a return to U.S. manufacturing are realized. It's going to take quarters and possibly years for that to occur. In the meantime, corporate earnings will suffer, margins will be compressed, revenue will go down as consumers don't buy. You could have a combination of the two. What does that mean? It means that this $270 value of earning per share for stocks right now, even with the market trading at 5,400 on the S&P 500, that's still a 20-time earning, which is too high. And so worst case scenario, I hate to say it, you could be seeing another 15% down from where we are now in the S&P 500. That's the worst case scenario. So where will this all go? What do you need to do? What's a bear market and what do you need to know? Well, since 1929, according to the S&P Dow Jones indexes, the average bear market decline in the S&P 500 since 1929 is... Find out. When we come back, we're going to play the bear market quiz.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander. People around here, they call me the Sandman. And that's because I help you protect your assets. And this week, it's been painful. My buddy Jim called me this week and was telling me a story about his daughter Jessica. You see, they were making lunch in the kitchen when out of nowhere, Jessica asks him if the bear market is going to ruin Jim's retirement. You see, Jim did well last year and he sold his company for a bunch of money. And since then, he and his wife, Linda, have been retired. But now that a bear is on us, his daughter, Jessica, wanted to know if they were going to have to sell their house and move. Jim started rattling off all these facts about past bear markets that his 8th grade daughter knew, but he didn't. And that got me thinking. The markets may be on everyone's mind, but what should you know about bear markets and your money? Since, well, we're in one right now. So today I thought I'd give you the bear market quiz and see if you know more than Jessica, the 8th grader. Ready? Let's go. Stocks are officially in a bear market when A, at least 2 major business publications proclaim a bear market on their magazine covers. B, stock prices end lower in the majority of trading days within a 90-day period. C, a broad market index such as the S&P falls 20% or more from its peak. Or D, the National Bureau of Economic Research declares it so. What do you think, Kevin?
I'm going to go with C, Dave.
Ding! The answer is C. A broad market index such as the S&P 500 falls 20% or more from its peak. But get this, the average bear market decline in the S&P 500 since 1929 is 39.9%. Whew. So according to the S&P Dow Jones Index, if we're down about 20% right now from the recent high, according to that statistic, well, we could have another 18% from here. So hold on. Next question. Which of the following is least likely to cause a bear market? A, a sputtering economy. B, higher interest rates. C, military conflict or geopolitical crisis. D, rising inflation.
I'm going to go with D, rising inflation.
Wrong. The answer is C, military conflict or geopolitical crisis. So far, anyway, military or geopolitical shocks to the market have been mostly fleeting. 2 of the longest downturns followed the attack on Pearl Harbor in 1941, lasted 308 days. And, of course, the Iraq's invasion of Kuwait back in 1990, that lasted 189 days. But the average time to the market bottom after usual events like this, including the terrorist attack in 2001 and the North Korean missile crisis of 2017, 21 days, with a full recovery in 45 days on average. Of course, we have two things going on right now. We'll see what happens with those and where they go. But anyway, next question. How do you know we're in a recession? A, the price of your lunch goes up 20%. B, the market goes down for 2 consecutive quarters. C, gas prices are over $7 a gallon. Or D, your daughter asks you for a 20% raise on her allowance.
D, Dave. I'm going to go with the best answer, D.
D, no. Sorry. The answer is B. A recession is a contraction of the market for 2 consecutive quarters. Now, the big question is, we just saw the first quarter, which just ended on the 31st, as we all know, last week. And according to the numbers, we were down for the first quarter. So now we're in the second quarter. And if we end this quarter down, which is possible, we will technically be in a recession. So that's the big question. How serious will that be, and how will that affect you? This year certainly is one of the most historic since we've seen in a very, very long time. And in fact, these tariffs that were just proposed are the biggest in over 100 years. And these markets could become tough. So we want to make sure that your retirement doesn't suffer because of it. So what we're doing right now is we are scheduling a quick 15-minute phone meeting to discuss what your options are right now if you're wondering how much more you could lose. Call this number right now. We got Zach and Dylan up there waiting to talk to you. Call this number, 866-PROTECT. Dial 866-776-8328. Coming up next, it will be time for our popular They Say segment, where they say bear markets happen once per decade. Is that true? Find out when we come back. Keep it tuned right here. You're listening to Protect Your Assets Show with David Hollander. That's me. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to PYAevents.com and signing up for our next free event. That's PYAevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. Hopefully you're not staying up all night, but maybe you are worrying about this market. I'm David Hollander, also known as the Sandman, and this morning you are listening to Protect Your Assets. And this past week, my buddy Jim told me a story about how just the other day, he and his daughter, Jessica, were making lunch in the kitchen. When out of nowhere, Jessica asks him if this bear market is going to ruin Jim's retirement. You see, Jim did well last year. He sold his company, he cashed out. And now he and his wife and his daughter are enjoying a retirement. Well, you see, they were in the kitchen, they're making sandwiches, and out of nowhere, Jessica, who's an 8th grader, by the way, she starts asking her dad about bear markets, and she was worried. And she said, "This stinky bear?" And Dad, you were in tech, Dad? You know, she knows what's happening. She said, are we going to sell the house now? Do we have to move? Well, Jim couldn't believe it. He thought it was pretty funny. Here they are making sandwiches, and next thing you know, she's rattling off statistics that she learned in class. And while bear markets are probably on your mind right now, or at least Trump or tariffs or something around that, you're probably wondering what you're going to do. All right, now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and sometimes bad advice that Jessica might say. All right, so here's one they say. They say that bear markets occur once per decade. Is that true?
False.
That's right. You are right.
Yeah.
That's false. Since 1932, bear markets have occurred on average every 56 months. Or every 4 years. And 8 months to be exact. When was the pandemic? Anyways, you're right. That's false. Okay, according to investment research, bear markets precede. This is what's interesting. I did not know this. Bear markets usually precede a recession. How do you like that? Since 1948, 8 of the 11 bear markets have been followed by recessions. In one case, the start of the recession came at roughly the same time as the market's peak, and the longest wait was 12 and a half months. The average time between a peak and the onset of recession, 7 to 8 months. So that tells you something right now, doesn't it? We just had the high. Right now, we just had the first quarter down. We're in the second quarter right now, and technically, if it finishes down end of June 30th, right, then we'll be in a recession. And so this bear that we're in right now will have made the averages correct and preceded the recession. There you are. Next question. You ready, Kevin? Here we go. All right, next question here is, the worst bear market on record was A, the 2008-9 Great Recession. B, the dot-com collapse of 2000. C, 1973 to 1974, when President Nixon resigned and we had the Arab oil embargo. I actually remember that. My mom was sitting in line with her Volkswagen. I remember that, sitting in line, right, with all these cars. Anyways, D, the crash of 1929.
I'm going to go with the one that I remember, 0809.
All right. Well, that's not correct. The answer, it's D. The bear market from September of 1929 to June of 1932 resulted in an 86.2% loss for the S&P. The others that we just covered, they're not even close. 2007, 2009, still pretty painful, 56.8%. 2000, 2002, .com, 49.1%. And the Nixon Arab oil embargo, 48.2%. So after the 1929 to 1932 slump, stocks didn't regain their prior peak until, get this, 1954. Can you imagine if you retired back then? What would you do? And that reminds me right now, if you happen to be in target date funds in your 401k, this is something you need to know. There was a statistic from an investment firm called Behavioral Research Associates. It's a survey they conducted. And they found that employees who invested in target date funds had the following misconceptions. Get ready for these. 57% of those. By the way, do you know what that is? That's where you buy, like, let's say you're working right now and they have a 2030 fund, and you just throw all your 401k in that 2030 fund because you're planning on retiring in 2030. That's what I'm talking about. It's target date fund. 57% of you surveyed thought you wouldn't lose money over a 10-year period of time. It's not true. 30% thought a target date fund provided a guaranteed rate of return. They do not. 62% thought they would be able to retire when the year or the target date of the fund arrives. So 2030, you can retire? Not true. TDFs are not a plan to get you to your goals, but rather just an asset allocation that typically becomes less risky as you get closer to retirement. But get this. You were talking about 2008, Kevin. Back then in 2008, if you were invested in a fund, a 2010 fund at that time, Here's a American funds fund back then that was down 27.45% in 2008.
I've lost my mojo.
Totally. So that would definitely change your trajectory of retirement if you were relying on something like that. And so just thinking that a target date fund provides asset allocation and a place to park your money before you retire, be careful with that, because we have found that those can be way off. So, for instance, you could be in one fund that would go down, say, 27.45%, but that same exact target date could be off 56% during the same period of time, or 12%. They're all over the place. Pick up the phone right now and call 866-PROTECT. We are scheduling live 15-minute crisis calls right now with one of our financial advisors to help you find out what you're looking at. 866-PROTECT. This will absolutely cost you nothing, but you have to call now. 866-776-8328. Find out what you don't know. It's time for a quick break, but when we come back, find out how long this bear market could last. It's all coming up next. Stick around.
If you missed any of Protect Your Assets with David Hollander, all you have to do is go to pyaradio.com, where you can download or listen to our latest shows for free. Just go to pyaradio.com on your computer or mobile device when it's most convenient for you. That's pyaradio.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I'm David Hollander, also known as the Sandman. People around here, they call me the Sandman because I help you sleep well at night by answering your most troubled questions about how do you protect your assets. And this week, wow, we certainly had a big drop. The bear market is back. S&P 500 from the top off over 20%. Same with the NASDAQ. And people are wondering what to do. Where can they hide? What should they do if they're getting ready to retire or they're retired and they need income? And so that's why Protect Your Assets is so relevant right now. If you want to get a copy of my book, Protect Your Assets, call us, 866-PROTECT. So today we're talking about the bear market. And it all started this past week. Of course, we know there was 2 painful days recently. And my buddy Jim called me and told me about his 8th grade daughter, Jessica. You see, they were making lunch, putting together their turkey sandwiches, figuring out what type of cheese they were going to put on that sandwich. And out of nowhere, Jessica says to Jim, "Daddy, are we going to have to sell the house and move?" Jim said, "What? What are you talking about?" And she said, "Well, bear markets go on," started telling him all the statistics she learned in class. And Jim started laughing. He couldn't believe it. One minute they were sitting there enjoying a moment together, and next, she's afraid of them having to move and change their life. Why? Well, Jim sold his company last year. And sure, he's in his 50s, and he and his wife are enjoying their life. Everything seems to be going just great. And now, out of nowhere, all the tech stocks that he was involved in have gotten crushed. So much so that at dinner, he's walking around talking about it. So Jessica got a little nervous. And she said, "Daddy, are we going to have to sell the house and move? I don't want to leave all my friends." You can imagine, right? So today, we've been going over the bear market quiz to see if you know more than Jessica, the 8th grader. We've certainly had some fun this morning. So let's get back into the quiz, shall we? But before we do, if you have questions, look, I did a market segment this morning. I went over the bear case for stocks moving forward and the bull case for stocks moving forward. So if you want to know what all that is, you've got to get a hold of the market segment. How do you do that? Well, do you listen to podcasts? Well, if you do, type in Protect Your Assets market segment, and today's segment will be posted Monday. All right, Monday. There it is. All right, well, let's go. Kevin, we got a question for you. On average, bear markets last A, year or less, B, a minimum of 2 years, C, 21 months, or D, seems like forever?
I'm going to go with B.
All right. That's not correct. The answer is C. Since 1929, the average bear market lasts 21 months. Whew, I hope this one doesn't go 21 months. Now that brings me to a lot of the noise that you've been hearing the last couple days. Should you jump out and sell everything right now? Well, that's probably a no. And here's why. Get this. According to the Goldman Sachs Asset Management Research, since 1990, if you missed just 10 of the best trading days each year, your average annualized return since 1990 on the S&P 500 would have gone on an annualized basis from 15.1%, that's smoking, to a negative 18% annualized. Yeah. I mean, think about that. That's crazy. That's terrible. So, the bottom line is don't try to time the markets. It just doesn't work. But that doesn't mean you can't get smart about income, because assets have to produce income nowadays just to live in the Bay Area. So, yes, you may have Social Security, you may have a pension, but I'll bet you're going to need a certain percentage of your portfolio to crank out a certain amount of income month after month throughout your retirement. And if you have no idea how to figure that out or what that looks like, and now you're starting to freak out because you're seeing your stocks go from 100 down to 50, then to 40, then to 30, then you're going to wonder, well, what do I do? You're not alone. So what do you need to do? Here's what you need to do today. You need to call us. You need to find out what are some of the things that we're doing now to protect your assets, keep more of what you have, and create income that'll last the rest of your life. How do you find out? Call this number, 866-PROTECT. Pick up the phone, call 866-PROTECT. They're going to email you my book, Protect Your Assets. I suggest you read that. This will be a meeting with myself or one of our financial advisors, and you can find out what we're doing to protect you right now, even if the market falls another 15 to 18%. How? How do you do that? Well, pick up the phone, dial this number, 866-PROTECT, 866-776-8328. Again, it's simple, 866-PROTECT. You can get help right now from a second source, 866-776-8328. Get help. I'd like to give a big thanks to the Protect Your Assets team today for a great show. This was lots of fun. Executive producer, network manager, answering all those questions there, Kevin Renford. Thanks, buddy, for participating. And, of course, all my fabulous producers working hard today to answer your questions and take the calls. Dylan, Zach, Raph, Phil. Thanks, guys. Because without my team, I'm just another pretty voice on the radio. You have been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You're listening to the Protect Your Assets Radio Network.